Welcome back. Now we will discuss module 7, micro analysis quantitative. Till now we have seen micro qualitative, up to that we have seen. Now we will discuss micro quantitative. Quantitative means numbers, very specific. So again our contact details and other details are given. Target audience, it is the same, there is no change in the target audience, hence we will not be repeating. Takeaways, big picture view of quantitative parameters, deep understanding of financial ratios. Then impact of qualitative parameters on financial ratios, how the qualitative parameters impact on the financial ratios, analyzing company's balance sheet, ratios and financial performance. So again the first slide, this is always the standard slide, macro and micro. We have covered macro, then within micro we have covered qualitative analysis. Now we are going to discuss micro quantitative, that is numbers. So what are the things that we will be discussing? EBITDA, earnings before interest, tax, depreciation and amortization, PAT, profit after tax, ROE, return on equity, ROCE, capital employed, liquidity ratios, leverage ratios, EPS, earnings per share, price earning, price to book value. These are some of the ratios that we will be discussing and analyzing in this module. So let us take this example, simple example we have taken. This is taken only for illustration purpose and it is out of our thinking that we have given these numbers. It does not relate to any real time numbers. Okay. Profit and loss statement of company X. Net sales 500 crores. Core business revenue after discounts. What is net sales? Why are we saying net sales? Sometimes what happens, there will be a gross sales and there will be a net sales. Suppose a company sells a product for 10 rupees and it gives discounts if somebody buys 3 products, then that means it will not get 10 rupees per product, but the discounted price. Hence the discount will be minus and whatever is the net money that the company gets, that is the net sales. This is nothing but the revenue. It is also the revenue of the company. Then we deduct cost of sales or direct costing. What is cost of sales? Raw materials, labor charge and other direct costs that are related to the manufacturing of the product. So in this example it is 70 crores. So when you deduct net sales and deduct cost of sales from net sales, that is what you get is 430 crores. That is nothing but EBITDA, earnings before interest, tax, depreciation, amortization, or it is also called as operating profit margin or also gross profit margin. So this is the actual operating profit a company is able to make. So number one, every company should try to make at least an operating profit. Forget about the other profits. So next is EBITDA margin. How it is computed? Simple. EBITDA 430 divided by 500. We have shown in this slide clearly the example. You can see for yourself. So that comes to 86%, which we will be using it down the line. That is why we are showing here. Next is we deduct DA, depreciation and amortization. What is depreciation and amortization? In this example it is 50 crores. What is depreciation? Depreciation is nothing but the value of assets that is depreciated and deducted in the balance sheet over a period of time. Let us say for example, I have bought a laptop for my company. So the laptop, the life of the laptop is 3 years. That means the asset is put in use for the business for 3 years. But if I were to show it as an expense in the first year itself, it will show an inflated expense in first year, but the asset is put to use for 3 years. Hence, it is distributed equally across the 3 years as written down as a depreciation value. So, of course, there are different types of, this is, as I said, this is not accountancy session. Hence, we will not go into detail into the written down value or straight line method and other methods. There are many methods which you can read through your textbooks. So, depreciation, because we are here to explain only the concepts. So, depreciation as a concept is deducted at this level. Then what is amortization? Amortization and depreciation are one and the same, excepting that tangibles is depreciation, intangibles is amortization. Like for example, for our company's logo, we have paid certain amount as fees for getting it registered and as fees. So that cost is written down over a period of time. That is called amortization. So depreciation and amortization one and the same. For tangibles, physically what you can see, that is depreciation. For intangibles, it is amortization. So here it is, in this example, it is 50 crores. Once we deduct that, what we get is 380 crores. This is called EBIT, earnings before interest and tax. This is the money that is available to bondholders and shareholders. From here on, you pay interest to the bondholders or debenture holders. So interest, in this example, 40 crores is paid. So once you deduct interest, of course, if any other income is there, you can add at this stage. What is other income? Any income that is not earned through the core income. Like for example, if we had put a fixed deposit for 10 lakhs, so we interest earned, that is not our core business. Our core business is education. So hence, anything earned through non-core is called other income. Obviously, other income has to be less. A small portion of the overall income. If other income is more, then the other income should become the core business of the company. So once you add other income, deduct interest from EBIT, what you get is PBT. What is PBT? Profit before tax. So now at this stage, what you have done, we have written down the depreciation, expenses, all the expenses in manufacturing we have taken, and we have paid the interest also. So this amount is before tax. So tax is paid on this amount. We have assumed 30% as corporate tax. Of course, now it is less than that, but still for just computing purpose we have taken. Let's not worry about what percentage of tax is there, because the concept has to be understood. The percentage I can change it to whatever is the real rate of corporate tax now, and I can change it. That is not relevant here. What is relevant is the concept. So once you deduct the tax, assuming 30%, it comes to 105 crores. So what we get is PAT. PAT is 245. This is nothing but profit after tax. So this is the money that is available to whom? This is available to the shareholders. It is purely shareholders' money or the owner's money. So what PAT margin is what? PAT by net sales into 100. As you can see here, line number 12, PAT margin is 49%. Again, I am going to earlier slide, slide 6. You see EBITDA margin is 86%. So EBITDA margin is 86%, but once you deduct depreciation, interest and pay tax, what you get is only 49% of the net sales. So dividend is, the company now out of this PAT, it can do two things. Entire thing it can put back into the business, or distribute the entire amount as dividend, or partially distribute as dividend, partially put back into the business, plowed back into the business. So in this example, we have taken as 145 crores is declared as dividend, that is given to the shareholders. So the balance amount 100 is reserves and surplus. That means it is plowed back into the business as an additional capital contributed by the shareholders. So typical profit and loss statement. I am sure you would have fully understood this. Let us look at the balance sheet. Sources of funds and uses of funds. Simple balance sheet we have put. We don't want to complicate it, because we are explaining the concept here. Equity 300 crores, reserves and surplus 100. How did it come? The balancing figure in the earlier slide. I am going to slide 7. Reserves and surplus 14. You see 100, that is taken over here in slide 8. Reserves and surplus 100. That is the net worth of the company. What is the net worth? Equity plus reserves and surplus. Many times now people wonder, they say what is net worth means, they get confused. Simple, equity plus reserves and surplus, because reserves and surplus are after all contribution of the shareholders. It is the profit generated out of the normal operation, hence it is part of the shareholders money, and hence it is a net worth. Then long term debt you add 150 crores in this example, that is an example. Current liabilities we are having 50 crores example. On the asset side, uses of funds, fixed asset 500 crores, current assets 100 crores. So total it is a balancing 600 crores. So uses and uses of funds and sources of funds. So P&L we have seen, balance sheet we have seen. Now let's look at the key ratios. You are seeing the picture here. As you can see, the green color is profitability, the pie, the green pie is profitability, then you have return ratio, then you have leverage ratios, liquidity ratios, efficiency ratios. So in profitability we have EBITDA margin and PAT margin, which we have seen in this example. Again we will discuss. Return ratio, you have ROE, RONW, return on net worth, standard and DuPont analysis, return on capital employed. Then you have leverage ratios, interest debt equity ratio, interest coverage ratio. Then you have liquidity ratios, current ratio and quick ratio, efficiency ratios, how efficiently the company operates. We will explain as when we see accounts receivable turnover, accounts payable turnover, asset turnover, inventory turnover. So then apart from that we have underlying box we are given book value, EPS, PE, market price, price to book value, enterprise value and replacement cost. These are the key ratios. So profitability ratios. What is profitability ratios? Profitability ratio tells how productive the company is. Simple, very simple. So two ratios as you have seen, one is the EBITDA margin, other is the PAT margin. We have already seen that EBITDA by sales into 100. In the example example we have taken, from there it is taken 430 by 500. In the balance sheet, in the profit and loss statement in slide 6 and 7 we have taken from there 430 by 500 into 100, that is coming to 86%, which you have seen. PAT margin is nothing but PAT by net sales into 100 equal to 245 by 500 into 100, 49%. Simple. So return ratios, profitability ratio tells us how profitable the business is, but return ratio tells how productive, how effectively the rupee is deployed. So how effectively the dollar is deployed. Return on equity, first is return on equity or return, it is also called return on net worth. Why? Because equity capital is nothing but equity plus reserves and surplus equal to PAT by net worth into 100 equal to PAT we have taken from there 245 into by 100, 400 into 100, 61.25%. So that is the return on net worth. So 2-point analysis, it breaks down that further. How it breaks down? PAT by net worth equal to, it is just a mathematical breakdown, and then PAT by net sales into net sales by fixed assets into fixed assets by net worth. So if you put here 245 by 500 into 500 by 500 into 500 by 400. So equal to 0.49 into 0.1 into 0.125. So straight away we can say here, by doing this breakaway, if we increase this 0.49 to let us say 0.60 or 0.70, then that means obviously our profitability PAT is going to increase. Hence it focuses on specific areas including PAT and net sales. Increase, it enables us to increase the sales and reducing the operating expenses. So in this example, if PAT by net sales is increased to 0.67, then it increases to 0.8375. So that means you can see it helps us focus on specific areas. Next return ratio is ROE, return that we have seen, ROCE, return on capital employed. What is capital? Capital means equity capital and debt capital. So that means what is the numerator we have to take? EBIT. EBIT is the money available for both bondholders and shareholders, right? So EBIT by capital employed into 100, ratio means into 100. So that is what it is. Alternatively, capital employed can be current total assets by current liabilities or total shareholders equity plus debt capital. So the simple way is capital is equal to equity capital plus debt capital. Leverage ratios. So debt by equity. So debt by equity in this example is 150 by equity is equity plus reserves and surplus, 300 plus 100, 150 by 400 is 0.375. So the lesser the better. That means we are having a lower debt to service. So it is simple. In your household, if you pay more of debt, then that means what you will eat, what you will enjoy going to movies, or what you will contribute to your education or enhancing your family value. Hence, debt has to be lower. So lower specifies, denotes lower debt servicing risk. Interest coverage ratio. This tells that how much we are earning and whether it is able to take care of the interest. Simple. EBIT by interest expense. So in this example, 380 by 40 equal to 9.5. Higher the better. So in this example, if let us say for example 380 by, if it is in 380 by 380, you think of it, then that means 1. That means our whatever we are earning, we are paying as interest. That means what we will give it to shareholders. So the higher the better. That means higher EBIT we are earning, EBIT has to be increased, interest expense has to be reduced. That means you borrow less or you borrow at a lower interest rates, and also improve your operational efficiency so that your EBIT is going to increase. Very clear? Liquidity ratios. Liquidity ratio tells very clearly current assets by current liabilities. So, current assets by current liabilities will tell you how much of liquidity you have. So, liquidity we have seen, how quickly you can convert into cash, how quickly you can meet the current liabilities. So, higher the better, right. Quick ratio, it is more stringent way of measuring. What it does is that in the current assets we deduct inventories. Why inventories we deduct? When we see the efficiencies ratios, we will discuss that in detail also. Inventory is something where there is a time period before we get the money. That means though it is a current asset, it strictly cannot be considered as a current asset, because by the time the inventory is sold to somebody, somebody has to buy that product, and then if it is cash and carry, then they will give the cash immediately. If there is a collection period of 30 days or 60 days, then that means that much time you do not have the money, whereas the people who have paid money to us, they want the money immediately, right. Our creditors want the money immediately, right. Hence, the higher, this is a stringent way of measuring. Efficiency ratios, as I said, accounts receivable turnover ratio. So, what it tells? Net sales by average accounts receivable. Higher the better. Why? Because example, you see 500 by 40, that means the net sales is 500, accounts receivable is 500. Think of it 500 by 500 by 1, that means everything you sell on cash and carry, that means it is 500, that means every sale is cash and carry, that means there is no outstanding collection, that means accounts receivable there is nothing, whatever you sell you realize the cash immediately. So, higher the ratio, it is better. Simple logic, no need to memorize. I know many students will keep memorizing, please do not do that. Asset turnover ratio, which again we use that in DuPont, net sales by fixed assets. So, it tells how many times we are selling the fixed assets, how effectively we are using to generate sales. As you can see in this example, 500 by 500, it is 1. That means the assets we are putting to use and generating only one time the turnover of the asset. Whereas, if you are able to, let us say net sales is 1000, that means the same assets we are generating twice that of the assets as sales. That means our PBT will increase, EBIT will increase, PAT will increase, everything will increase. So, a classic example, let us say for example a college is there, a college has, let us say for example has 50 students, it can induct 50 students, it charges 1 lakh rupees as annual fee from each student, that means 50 lakhs it gets revenue. So, the classroom is the same, light and everything, of course the current charge will be slightly more, but the classroom and other infrastructure is the same, the fixed assets is the same, right. Suppose the college instead of 10 to 4 the classes, they decide to have 2 classes, one from morning 7 to 2, another from let us say 2 to 8, something like that. That means they can induct another 50 students and earn another 50 lakhs with the same assets. So, this is a classic example of generating more sales with the same fixed assets, higher the better. Accounts payable turnover ratio. So, accounts payable turnover ratio is the opposite of accounts receivable, total purchase by accounts payable. So, in this case 200 by 54, higher the better normally from a mathematical formula perspective, but sometimes what happens, if it might not work out always in our favor, hence we have to draw a thin line between that. Sometimes if we squeeze too much our vendors, if they go burst, if they supply critical components to us, then we will be in trouble. Hence, it has to be a fine balance that you have to achieve, though mathematically higher the better. Inventory turnover ratio. So, sales by inventory. So, in this example 500 by 25, which is 20. So, higher the better denotes higher inventory turnover, that means less of inventory and we are converting quickly into sales. So, the higher the ratio, higher it is better this ratio. So, thus we have seen these all these efficiency ratios and other ratios. Let me go back again to slide 9, key ratios. The green picture, green pie, profitability we have seen, return ratios we have seen, leverage we have seen, liquidity we have seen, efficiency we have seen. Now, let us go and discuss the items that are mentioned in the box. Again I am going back to slide 6, slide 16. Other key ratios, earnings per share. What is earnings per share or EPS? Normally when you talk to any market player or anybody in the investing circle, they will talk what is the EPS. EPS is nothing but total net profit by total number of outstanding shares. So higher the EPS, better the stock price, right? So hence every company tries to achieve higher EPS. How the higher EPS can be achieved? Increasing the net profit. The total outstanding shares remain the same, right? You have issued the shares, that remains the same. So the only thing that can be increased is the profit has to be, net profit has to be improved. So to improve the net profit, you have to improve the operational efficiency. To improve the operational efficiency, you have to work out on all the ratios that we discussed earlier. Then price to earning ratios. What is this? PE. It equal to share price by EPS, okay, or equal to P equal to price equal to EPS into discounting we call. How much time the market is ready to discount. So that means the higher the EPS, let us say for example for an industry, the market will be ready to discount 20 times. That means if for that industry, let us say it is an automobile company, automobile industry, market is ready to discount 20 times. A company which is earning 20 EPS, that means it has to quote 20 into 20, 400. Suppose the company is able to increase the EPS from 20 to 30, that means 30 into 20, 600 the share price has to quote. So hence the discounting is something which the market gives. So EPS is something which is in the hands of company which it can increase. Other ratios, slide 17, book value per share. What is book value per share? So market value is the market price is the price that is quoted in the stock markets. Book value is the value computed by the company in its books. It is nothing but the total net worth by total number of outstanding shares, right? Simple. So hence always book value is compared to the market price. If market price is more than book value, the company will be happy because the market is ready to give higher price than its book value that company has worked out. Price to book value, again it is share price by book value per share. Enterprise value, what is the enterprise value? Market cap plus market value of debt minus cash and cash equivalent. So market enterprise value, what is the total enterprise, the value of the company? That means market cap. What is market cap? Total number of issued equity capital into the share price, that is the market cap, plus market value of debt, right? Whatever is the borrowing minus any cash and equivalent that is deducted. So that gives the enterprise value. That means if somebody wants to take over, this is the enterprise value that he or she has to give to take over the company. Replacement cost, present cost of setting up the infrastructure of a company. That means if let's say for example, if I were to set up a let's say steel plant of something like an existing steel plant, what is the cost that I have to incur to set up a similar plant of similar production capacity and similar facilities? So that is called the replacement cost. So that means why? Because many of these companies, they have bought, they are 50, 60 years old companies, they have bought the real estates, land and other things at historical prices which was a low price. Today the value of it has moved up exponentially. Hence, if I were to set up a similar factory or similar facility, what is the cost? That is called the replacement cost. Or if I were to replace this with a completely new one, what is my cost? So some of the other ratios which you have seen here, right? EPS, PE, price to book value per share, everything we have seen. Enterprise value is the theoretical value which you have seen. Market capitalization, replacement cost. Thank you very much.